these guys are really dedicated to the advisor business, and obviously they bring a lot of really good experience to bear. So I think you'll all be interested in their sort of point of view. And I think, the other thing is, I'll set the table a little bit, even though we've been hearing it set today by a bunch of people smarter than me about where we are as a business. But there was a great writer, it was Hemingway, I think was the guy who said, whenever you're telling a story, don't forget about the weather, right? Because if you don't talk about the weather, you don't put your story in context. And the weather that we're facing is, rough right now, or at least it's unprecedented, I would say, that we're sitting in a position where, you guys look nice and cozy, that's great. That's right, we need a fire. I think we're in a position where, we're coming through genuinely unprecedented times, and those times have had an impact on our business. And as I said earlier, we're lucky in some ways because we had a low impact business with something that really badly impacted other parts of the economy. But there are a lot of, there's a lot of, 20 and it was a dumpster fire, we leave it behind, it's great. But there's things we should be taking out of it. And I think some of those things are transformative because a lot of the larger themes that have happened in our business, like folks moving from wires to independence, or at least wires to, other firms that share that ethos that the independence firms do. With all that movement, there's gives and gets, right? So there's an idea here that maybe I'm leaving behind lending, or I'm leaving behind this side of the balance sheet. And then you have all this volatility. It's kind of two things I want to talk about, get your opinions on. One is we have inflation, we have, this weird tax stuff possibly coming, capital gains maybe, that's really impactful capital markets. We have this volatility, and then we have this sort of larger overreaching folks moving to independence and maybe not being able to take some of the lending stuff. I'm sure you saw that opportunity there, but how do you address, both of those things? So just a sort of dual question. Whoever wants to take the first part can do it.
Well, maybe I'll kick off. Thank you. Good to see you again.
Thank you.
We were virtual last year. Let me define what GS Select is, if that's okay.
Sure.
And so what we focus on is really an end-to-end digital private bank solution for the independent advisor market. And I appreciated the comments from the panel because these independent advisors have the ability to scale their business powered by technology. And so our digital offering, which is, today we lead with lending, security-based lines of credit. We make it available to independent SEC RIAs, independent broker-dealers. Our book has grown dramatically given, the market's doing quite well, rates are low, but we've seen our book double since we met this time last year. There's a lot of changes, tax changes, the advisors striving for relevance. So every day they're looking for new ways to differentiate themselves if they are independent, which they are. But that's what we do. Where we sit, Tony, we sit within the consumer wealth management business at Goldman alongside Marcus. Marcus is a direct-to-consumer offering on the bank front, a digital bank. GS Select is the digital bank offering that we've been in business almost 5 years now, focused on the independent space. So that's where we sit in the business. I think the biggest trends, though, to answer your question, are two or threefold. Number one, the massive transition from commission to fee-based has really empowered advisors to build a holistic financial plan, right? They want to be the financial quarterback for their client. And in doing so, they've expanded their view from just wealth and asset management to actually planning with the other side of the balance sheet in bank assets.
That's critical in my mind because you look, even as far as 8-10 years ago, you go independent, you didn't have the option, or you didn't know who to go to, or a lot of folks just left it behind. If I left Merrill, I'm going to leave the banking behind and start my own RIA, and that's it.
Yeah. So, and I enjoyed the comments. Doug and John both spent time on empowering advisors. Technology has enabled independent advisors to build these practices with scale and use balance sheets from Goldman and other competitive places. But that's kind of the what, where, and why of what we're doing in GS Select. All the while the market's changing, tax laws are changing. And but advisors, one consistent thing is they're striving for relevance, whether they're an advisor, independent, SEC, and we really benefited from that.
Yeah, great. And Whit?
Yeah, I think our heritage is relevant here. The business came out of the private bank, which serves the high net worth clients at Goldman Sachs. And a lot of what we've learned was based on the lessons we encountered building that business. And we really started this because of the tremendous growth in the independent space. And actually, we had a couple firm clients that approached us, say, would you ever lend to our clients? And that was really the impetus for us starting to work with the independent advisor space. So what Tony and I do together is focused 100% on the independent advisor space. And our focus is trying to deliver fully digital 21st century banking products to the advisors to help those advisors build their relationships.
What are you guys seeing? I mean, we talked about both sides of the balance sheet. I obviously feel it's important because if you're not talking to your clients about this stuff, somebody else is, right? So how are you seeing advisors use with working with you guys? What's sort of the initial benefits, and what are they using? What are they getting the most out of for their books?
So our product set today, we talk about leading with lending. So we have, the acronym is SBLOC, Security-Based Lines of Credit. And we've seen that book grow. We'll finish the year at over $10 billion notional. However, and Whit will spend a minute on this, we're building out a whole suite of products from card to deposit to high yield savings to someday maybe even mortgage. We're exploring. That's not imminent, but we're exploring a lot of areas. But going back to differentiating ourselves in the marketplace. And the one thing I would say is, in the first quarter of 2020, we had an investor day here in New York, and we actually unveiled the global strategy for Goldman. And a very important part of that was the consumer wealth business, both Marcus, direct to consumer, and the business Whit and I co-lead, really the digital offering for advisors. So the one thing I've learned in the past 12 months is anything around the RIA market within Goldman, there's interest. People are fascinated, and they look at the growth, and that's why I thought the panel discussion before was fascinating.
What do you find? I mean, is there stuff that you have to do education-wise for advisors? I mean, get people up to speed on this. This is where you should be concentrating on.
Well, I think a lot of what we do, as Tony said today, is focused on SBLs, or SBLOCs. And if you look in the wires, that's a really big business for them. It was relatively untouched in the independent space, which is kind of why we started working there. And what we've had to do over the last 5 years is spend a lot of time educating and raising awareness at the firm level and at the advisor level. And I think we've been laying a lot of seeds and kind of building those relationships and help them understand why what we can do makes sense for them. And in short, what we do is give advisors and clients an option when the client needs liquidity to access liquidity in some other way than by selling assets. And that's really the fundamental value proposition for what we can do. And that has benefits directly for the clients if you kind of look at the economics, right? And the economics are pretty straightforward. On the one hand, if a client needs, let's say, $500,000 that they want to buy a second home or do some other activity, they could liquidate part of their portfolio, and that will have some implications.
Well, there's risk associated with that too. Right?
There's risks, but they basically have to get out of the market for whatever portion. That means that they will also most likely incur some kind of tax implication, which you mentioned. With a lot of the tax changes, obviously that can be very relevant right now. And so if you need $500,000, you might have to sell $600,000, $650,000 to get what you need for that investment. And so you have a tax, realized cost, and then you're out of the market. And if you have actively invested clients, obviously, certainly you would not want to be out of the market over the last year and a half. Right. You contrast that to the cost of borrowing. Today, if you want to borrow $500,000, it's 3% or so. So it's a very attractive trade-off. Now, obviously, that can change, right? The question is, what will the market do going forward? And that's where all you will prognosticate effectively, I'm sure.
Well, as I remind my team, market's at an all-time high, rates at an all-time low. We should be doing well, so we do have a tailwind. Just the one thing I'd say we've learned, though, we have heard loud and clear, independent advisors do not want to be bankers. Yep. I know Whit did a lot of pre-studies before this business even launched, and we heard loud and clear they want to see all the assets, whether it's through eMoney, Money Guide, Right Capital. They want to see the full view, but they don't want to be a banker. That we've heard.
This whole COVID thing, I think, and the volatility has made people see that their clients need liquidity sometimes.
Yes.
And that's where am I going to do it, and that's where.
Well, what's interesting is if you look at how the product is often used, the largest single use is for real estate. Buying real estate, renovating, handling, if you have to sell, buy a home before you can sell your home, those kinds of issues. What's interesting in the COVID era is you see how hot the real estate market is. I think I saw in the journal that the average time for a house to be on the market is a week. And what you can do is with this kind of a product, you can actually make all cash offers, right? Because you can basically use your securities portfolio as collateral to get the cash you need to make the purchase, so you can buy with confidence, and then you can put a purchase mortgage on soon after that. And so it gives you great ability to move quickly in this real estate market. So that's one of the interesting changes we've seen, certainly over the last year or two, because of the environment. Yeah,
well, I guess doesn't surprise me when you think about it. Another thing we talked about earlier today, because people mentioned real estate, is the digital world, right, that we're coming to. You heard Ron talk about digital, then we heard Chris from Fidelity give his really good talk on it. Clearly here to stay, but still undefined in some ways.
Well, look, we strive for high tech, high touch. So we have a dedicated service team. We have 12 regions. All of our regional banking directors have over 20 years banking experience, classically trained credit, but we also want to be off the glass, high touch, and we can approve a line of credit in the best of days in under 30 minutes with all the appropriate information. That doesn't mean we're going to deliver the proceeds in 30 minutes, but we can do it quite fast. And I think that's a differentiator of our offering, is the digital nature of what we're doing. Credit Whit helped build the entire private bank at Goldman, and in 15, 16 looked at the opportunity within the independent space and said, look, we can externalize this capability, for our ultra high net worth clients to the independent space. And the digital piece, I think, is a differentiator.
What's interesting though is digital is not enough. So you definitely, table stakes, I think, going forward is you have a digital platform, the ability to do everything front to back, originate, service, everything online and digital and very simply.
And the advisor has that in front of them.
And the advisor has that in front of them. And part of what we do is focus on making sure we empower the advisor. So we push all the information and all the control to the advisor, because they're the ones who are really our clients. But digital by itself is not sufficient. You still need the people to work with the advisors and clients to make it work. And everyone will be a little bit different, and sometimes people will get more comfortable with the technology over time. But if you only have digital, it won't work.
Well, that's a challenge. It's a challenge, though, because even in this room, look around, you got single RIAs that have $1 billion, and then you've got firms that have $17 billion. Then you got people like Kip, as you're talking about putting different firms together. He's got. How do you work with that when you see all these different types?
Yeah, so we spent a lot of time in the last 2 years on segmentation. Our book is primarily independent broker-dealers who worked in a wire and they understand lending, right? They've done it for 15, 20 years. But the fastest growing segment is actually the SEC registered investment advisors.
I bet.
And they're both critical segments, Tony, but quite different. And the one thing I would say is the comments earlier around independence and how you can do this, you can do it because of technology. And what the custodians and the clearing agents have built with these API storefronts, we're able to really take a digital private bank offering, put it in a module format and deliver it to an API, whereas if you're an independent advisor, it's seamless. So you now have the balance sheet of leading banks.
And I've been at a bunch of firms and managing big offices and stuff, and dealing with rates is always a bargain and a hassle, and you're back and forth. How do you guys handle that?
Well, we have the best.
Of course.
No, I'm joking.
You're talking rates on
of course.
Sure.
Yeah.
Yeah, the price is always
right.
the first question, right? And we do spend a lot of time trying to make sure they recognize its price and experience, right? You need to be competitive, but it's also the experience your client goes through.
Right.
And we've had situations where people walk away for other people's lower priced offering, and then you seem to see them coming back later because of the experience. But price is always relevant, and so we believe we have to be competitive and in the market. But we don't have to necessarily be the lowest because we do deliver other value. And so we'll work with advisors to make sure that on a client-by-client basis, it's priced appropriately for that situation.
Well, I'm interested in a lot of what you said about the post-COVID world. Now, this is sort of drifting into, home loans and things like that. What do you see, going forward? And I think technology in general has changed, right? People are doing a lot more over Zoom. I imagine if this was 10 years ago, you guys have been doing wholesalers going face-to-face, and you're probably doing a lot of digitally now, right?
There's definitely, the whole model of kind of interacting with clients and advisors has changed. It is definitely much more online and much more digital. I think and that will, I think, grow over time. I think it is still, there's still a role for that in-person interaction. I think I see that here today, right? The opportunity to actually meet people. And I know I may be unusual, but I actually have liked being back in the office. I actually like having the ability to see people face to face and work with them. And so that component, I think, will always be important, but it'll be balanced now, I think, in a different way in terms of how we have to work with them.
Tony?
I just think it makes it that much more competitive because things have accelerated.
Yeah. Things are moving faster post.
The things have moved so much faster, the connectivity, the competitiveness. Whit, I think, said it appropriately on the rate front. We may not always be the lowest, but our value proposition is that high tech, high touch.
Anything else that you're seeing? This is an example of a post-COVID world. Everybody here has been vaccinated. We're just comfortable. We're going to have to live with it. What are you guys seeing as sort of trends that are, especially in the lending side for advisors post-COVID? Now that we're in this new universe.
Yeah. But Tony mentioned it a little bit, but I think where we see this going is a broader private banking set of capabilities, which is both lending and cash opportunities. And I think Tony said it well. No advisor wants to be a banker, and that's actually one of our biggest hurdles when we start talking to them. What we find is we focus on trying to empower the advisor and their team to do what's needed.
But that's critical because they don't want to be a banker. B, why lose the business?
That's right. So we need to use the technology to do the work that historically they might have to do as a quote unquote banker, and empower them to strengthen their relationship. And they focus on using our products to meet the needs that their clients have.
Right.
And so that's where the investment is coming from our side, which is how do we deliver it in a way to make sure that empowers the advisor, puts them in the driver's seat, and they don't get wrapped up in a lot of paperwork, documentation, process, things that they don't want to do.
Things that are soul destroying.
Yes. I think the other thing on that is around the direct-to-consumer bank. What we've heard loud and clear is the advisors want somebody on the other end of the phone to, number one, pick up the line. So we've got strict, SLAs we measure. But they also want somebody who understands what an advisor does for a living. And in my former life, I actually ran a product and fintech team. We had banking relationships, but most of the reps were swiveling the chair. They would answer the direct consumer call, and then they would talk to the advisor. We're 100% advisor focused. Now, because it's a banking product, we are required to have a relationship with the end client, no doubt. But we get good feedback in that, we're advisor focused, and that's who we serve.
What I was just going to say, one of the things, because you asked a little bit about lending again, Tony, we haven't talked too much about risk, but obviously whenever you lend, you have to think about risk, right? And one of the key issues, obviously, in lending, particularly as an advisor, is they may say, well, look, I don't want to get my client in trouble, right? You think about a securities-based loan, market values change.
Margin calls,
maintenance calls. Right, and that's a big focus for us is to try to avoid that. I think we're very much aligned on that because we don't want the advisor or the client to have an issue when it comes to this.
Because we talk about the other side of the balance sheet, right? You got people here, you can make money with it, but you can lose money with it. So you need a partner who can tell you that so you don't get into trouble, I guess. Well, I used to, branch managers here, there's a bunch of that was the branch manager's job. You used to have to watch everything and make sure that they didn't had to sign off on every margin loan.
That's right. And here's where we use a lot of the technology to make sure that we assess the suitability effectively, and then we manage it using market but relatively conservative collateral standards, so we're not overextending. What we find is for every dollar that's lent, there's $6 of collateral the client has with us. And so I think both the advisors and the clients recognize, they're not here to lever themselves up to the last dollar, and that's not something we want, and that's not something they want. It's really more to unlock some of that liquidity so they don't have to sell and get out of the market and realize those taxable gains.
In a volatile market, you want to stay invested, right?
That's right.
And we went through that, obviously February, March of 20, and that was a good learning experience. But what we learned is, we were able to respond, but demand continued to go up. Interestingly, but Whit and I always talk about, okay, like what's it look like, when VIX is at 60 and the market pulls back, 10%, 20%. So we model, those environments. The one thing I would say that where we're focused today is the desktop of the advisor. I think everyone knows that's competitive landscape, and there's APIs behind it that are really drilling, these great vendors and partners, in front of the advisor. And so we spent a lot of time looking at platforms, not just direct broker-dealer relationships. Today we have, approaching 300 agreements with REAs and independent broker-dealers, access to 50,000 plus advisors who could actually do a line of credit. But we're actually looking at other platforms that are so crucial to the advisor, and building integrations in there as well.
And delivering the education. Because you're going to have, I think the opportunity grows if you can train and teach and bring advisors in. And like I said, there's two sides to a balance sheet. We almost always just concentrate here, and there's a whole nother level. Well, believe it or not, we got to move on. Any last thoughts that you want to leave everybody with before we go?
Well, I think we're very excited to continue to build. We'd love to hear, from you, directly or indirectly, on what you need. We have ideas in terms of what's coming, but I think there's a lot that we can do to give you the access to that other side of the balance sheet, but also that part of the cash that's held at the banking side of the world. And that's part of what we hopefully will deliver over time for you and your clients.
Great. And that's what's great about these events is you can hear directly from the consumer right away. So please come up. They're really nice guys. Talk to them and let them know. But thank you very much for being here. I appreciate it. You run a business. You have an RIA. We've got to get our arms around the lending part of it in a safe way because other people are talking to your clients about it if you aren't. So. Thank you very much. We are going to hear from Ron Ransom. You want to go ahead and do it? Thanks. And he's going to be our digital guy, and then there's lunch. So the food's pretty good, so we'll be all right.